So, like we talked about, for a company to survive and do better than other companies, it's important for the company to be able to control the costs. What do we mean by controlling the costs? We need to identify the inefficient part of production or operation and work on that. And to do that, companies need firm knowledge of the costing system. Well, we have costs, which indicates the financial resources put for the other resources companies possess. Costing talk about methods to figure out those costs. And we do have different costing systems, and today we're going to talk about something called job order costing. In our daily life, we see a lot of products we often see here in grocery stores or from newspaper. Here is something many people eat for breakfast, the cereal. It's called a drumstick, family size. I never had it before, but cereals. And the second is pencils. What does pencil and the cereal share in common? We know that they are, one is food, one is stationery. That's definitely the difference. But the thing they share in common is that they are both processed in large order. There might be customers in Canada want pencil, in New York want pencil, want cereal. There's people in Texas, in Mexico, in other parts of the world wanting cereals and pencils. And when they put order, no matter how big the orders be, pencils will be processed in the same or very similar way. And the same for cereals. On the other hand, we do see some businesses different from we just talked about. For example, here is a customized automobile. And based on my limited knowledge of automobile, I know different people want different things. Some people might say, hey, I want some flashy, shiny lights. Some people want some fancy paint. Some people want a more powerful engine, and some people want more annoying or air-waking exhaust. So for people in this kind of business, they know when their customers comes in, every customer probably want different things. And the different things for their cars means different costs, means different ingredients, means different time consumed to make those, and it means different manpower to put to these for each customer. So this particular customer's order cannot be treated the same as other customers' order because they are so different. Another thing, if you watch those things like Law and Order, those TV shows, for law firms, their cases, their service is very unique among each other. What do we mean by that? You might have a big client, you might have a small client, you might have a big case, you might have a small case, you might have a case involve criminal charge, you might have a case that is purely civil. And there might be fraud related cases, there might be some small traffic ticket cases. So each case, probably they are very different from the other, meaning that law firms need to put different experience level of lawyers, charge people different rates, and they need different numbers and experience levels of assistance to work, to collect the materials, to talk to different parties. So each order, each case cannot be combined with others because they are processed so differently, the cost ingredients are so differently, so they have to be calculated separate. Same for those names. If you're not familiar with it, those are the big four audit firms in the world: Deloitte, PwC, Ernst & Young, and KPMG. And for the auditing business, it's similar. They audit their clients. Their clients are publicly traded companies at large. So for publicly traded companies, we know that there are no two companies that are exactly the same in the world. Different companies, they are in different industry, have different scales, operating style, and have different size, etc. So for those different clients, audit firms need to figure out how many people I have to put there, what experience level I have to put there, and how long do I have to commit my team for the clients. So again, each case, each product is processed differently. So that's the difference between the left-hand side and right-hand side. For industries like those on the left-hand side, we cannot group all their job orders in a similar way. We have to treat most orders differently, so we call them job order costing. Why we call them job order costing again? Because each case is so different and they need specific attention. They need a specific cost sheets to figure out how much those orders cost. So this is basically the job order costing we talked about. As we said, there are a few reasons we need job order costing for certain industries. And why job order costing can be used to control costs. First, let's talk about cost formula. And we know what costs. We present here total costs equals to direct material plus direct labor plus direct overhead. And we also have the cost formula, which is total costs equal to fixed costs, variable costs plus fixed costs. So what are the differences between those two? When we talk about a fixed cost, variable costs plus fixed costs, we categorize the costs not based on whether they are directly related, can be pinpointed to each product or not, but most likely to be based on whether the cost will vary as output increases or as cost driver numbers change. Well, fixed costs is something that don't change as drivers change. And for this formula we put here, we based on whether costs can be pinpointed to each product. For example, direct material refers to, for each product, refers to the direct material that is consumed to make the products. Direct labor for each product refers to the manpower consumed for each product. And for other costs, for example, like electricity, like water, like maintenance, it's not really something we can pinpoint to each product, so we call them overhead. But pay attention to this. We call them overhead, doesn't mean that they are fixed. Overhead is supposed to have fixed components and variable components. We're going to talk about it later. So if we want to control costs, we have to understand the costs. And to understand costs, we have to focus on the most difficult to control cost components. So which of these three, direct material, direct labor, and overhead, which of the three is more difficult to control? For direct material, it's not too difficult, right? For example, if you need 2 pounds of plastic to make a plastic chair, then you know that's a direct material cost for each product. If you have 1,000, that is 2,000 pounds. If you have 10,000, that is 20,000 pounds. 20,000 pounds. It's easy, not too much brainer, right? We can easily attribute the cost change to whether it's price change or it's used too much. And then for direct labor, it is the same. If we need half an hour of each labor to make a product, then if you have 1,000, it's 500 hours. If you have 10,000, it's 5,000 hours. So direct material, direct labor, because they can be pinpointed to each product, they are not very difficult to analyze. Although we will talk about how to analyze later, but they are not the most difficult to analyze. On the other hand, we have overhead. Why overhead becomes so difficult? Of course, by its name, you know what is overhead. Overhead are those costs directly related to production, but cannot be pinpointed to the products. Meaning that if you have more products, they might cost the same, or the costs don't increase in a linear relationship with the products. For example, for rent of the workshop of the factory, no matter how many products the company make each month, the rent will be the same. For electricity, it's not going to be the same, but it's going to be mostly depending on the machine hours instead of products. And also, if you have supervisor salary probably depends on how many hours the factory opens instead of actual products they make. So how do we control it? First, we have to understand that is for overhead. There's variable components not necessarily varying with the number of outputs, and there's fixed components. So we need to understand for those overhead components that varies with something, we need to understand what is driving those overheads. And also another thing important is we need to understand, right? If we talk about daily life, sometimes, I'm married, right? Sometimes I go to do grocery shopping. My wife says, why you spend so much on this? Why you spend so much on steak? Or in our daily life, your friend told you, hey, I just spent $200 on my sneaker. How good does it look? Your response might be, you spend too much, or that's a steal. When we say this, what do we mean? How do we tell people the sneaker price, whether it's a steal or it's too much? When we say this, unconsciously, we are comparing to a benchmark, which is expected or normal price we are talking about. If you know your friend's sneaker, normally, if you go on the website or whatever stuff, for an authentic pair, it's going to cost $180, so $200 is a little bit too much. On the other hand, if it's a $250 or $300 sneakers, then they got a steal. So what we are talking about when we are talking about spending too much or not too much, unconsciously, we are comparing to a number that we deem is normal. So we are doing the same when we talk about managerial accounting. When we want to talk about whether overhead is managed effectively, efficiently or not, we need to have an idea of what is normal overhead. All right, so we need to develop that. And then we compare the actual overhead committed to the normal overhead or expected to be overhead. We can get an idea whether overhead is used efficiently or not. So to do this, first, we need to understand what is driving overhead. Like we said, overhead might be determined by machine hour. For instance, assembly line depreciation. We know how assembly line works. Somebody in the morning turn on the assembly line goes on and does the work. However, there might be more products. Each product line, assembly line has maximum efficiency, right? So they can be doing full capacity, or they can be doing 80% capacity or 50% capacity. But no matter what capacity they are doing, the electricity charge should be the same or very similar, no matter what capacity you are running at. So the electricity hour has nothing to do with each product, because every hour different number of products can be made. So it's related to machine hours instead of number of products. Overhead might also be determined by labor hours. In some labor-intensive industry, for example, overhead might include supervisor salary, safety equipment might be determined by how many workers are at the scene and how long they work. So it's going to be determined by labor hours instead of machine hours. And for labor hours, we know they can be very efficient, very inefficient, or there's different amount of people. But whenever there's human beings present in place, we might need supervisor there as well. So again, those types of overhead cannot be traced directly to each product, but they are more likely to be related to labor hours. And of course, there are other drivers, right? So again, for us to figure out job order costing, what we have to keep in mind is when we do job order costing, we need to fully realize that when we do job order costing, we want to analyze, because each order is very different. And for us, it's not very difficult to figure out the direct material, direct labor of each job order. But overhead is going to be a different animal. We need to be careful with this, and we need to understand our overhead. And to understand the overhead, we need to first be able to tell whether overhead varies with some kind of driver or not. And for those that varies with some kind of driver, we need to understand the drivers for the overheads. And after we do this, we should also have an idea of what's normal or hypothetical relationship association between the overhead parts and other components. So we can develop an idea is for each driver of the overhead, what's the cost for each driver? And then what we call this predetermined overhead rates or applied overhead rates. And then when we have the actual number of drivers, we can easily figure out the normal or expected overhead based on the predetermined or applied or normal overhead rates and the actual number of drivers. Then we can compare the actual overheads to the normal overhead, And then we got an idea of whether it's too much spent or too little spent. If actual overhead is higher than normal overhead, we call it under-applied, meaning that our applied or normal overhead is too low. And if actual overhead is lower than the planned normal or applied overhead, we call it over-applied, meaning that our expectation, what we thought would be negative, what we thought would be normal, is actually too much for the production. We need to, right? So whenever we find the differences, there are two consequences. One is that our expectation, which is normal overhead, is not set up in a good way. The other reason is something good or something bad is happening, and which we might look into it to see if it persists or not. If it persists, we need to change, or if it's just one-time shock, we just determine what we need to do in response to this. So to do this, let's do a practice. When we work on the calculation, I want everybody to focus on the thinking process instead of the numbers itself. And to solve a problem, no matter which major you are, I think it's going to be all the same. First, we need to understand what the question is asking for. And to do that, to solve the issue, we need to read through the question carefully and understand what each piece of information, what it means to us, how it helps us. And then we see and in the process, when you are practicing, for each piece of information we collect at that moment, we need to think about it. So far, what is this information can help us to produce? Then we see the question, we can easily solve this. So follow me, let's do this together. At the beginning of the year, Horvath's company estimated the following. So we know that it's estimate. Oh, what am I doing? I'll make it larger. So we know that estimate. And what are we estimating again? So overhead and the direct labor hour. And the overhead is supposed to be 486,400. I just like these to be the way I want, all right? And the labor hour is supposed to be 95,000. So what can we get here? We know it's an estimate, so it's probably refers to the expected overhead for the expected overhead hours. So let's do this. So with the information we have so far, we can develop what we call expected overhead rate. Overhead rate is per hour because based on the knowledge we know, here overhead is based on the direct labor hours. So here we divide 400. So here we develop 486,400 divided by 95,000, and we got the hours we need. So hypothetically, for each labor hour, it's associated with $5 of overhead costs. And let's move on. So Horvath uses normal costing and applies overhead on the basis of direct labor hours. For the month of January, direct labor hours were 7,830. So here we have some actual information, and then let's talk about hours. 3,830. And we have a rate already, which is under normal circumstances. So what we know for sure is for the actual hours, which is 7,830 hours. There's no way, because it's fewer than the expected hours, meaning that they either be very efficient or they didn't have enough job hours they expect. So there's no way for the normal overhead to be 486,400. And it has to be based on the rate of expectation and then multiplied with actual direct hours. So what we know is for the month of January, the hours were 7,830. And we know that normally we expect $5 for each hour. So here we know the expected hours for January is gonna be like this. What am I doing? So it's not really, okay. And then what we also know is by the end of the year, the following actual months have been applied. The overall for the year, the direct labor hour were 93,500. So if you use the same logic again for the whole year, we expect the expected or normal overhead cost to be 478,720,000. So now we can compare to the actual annual overhead, which is 476,100, and we got an idea, right? Looks like they are doing better than expected because 476,100 dollars is smaller than 478,720 dollars. So we didn't even look at the question, but what we are doing here is to utilize the information we have been provided and solve everything we can possibly do. So here, question number 1 is predetermined overhead rates. We said a predetermined overhead rate is based on the expectation. And for the whole year, the company expects overhead cost to be $486,400, and the labor hours to be 95,000. So we know that expected overhead rate is $5.12. And for question number 2, overhead applied to production in January. January hours were 7,830 hours. So we apply the overhead rate, which is $5.12. We got $40,089.60. And Q3 total applied overhead for the year, we know it's gonna be 478,720. And Q4 overhead for the year, over applied or under applied. And we know expected overhead for the year is higher than the actual overhead for the year by 2,620. So we know applied overhead is too high, so it's over applied by 2,620. And Q5 adjusted cost of goods sold after adjusting for the overhead variances. I just missed the unadjusted cost of goods sold here. So we know that unadjusted cost of goods sold here for this company is 700,000, 707,000. So what does it mean? For companies use job order costing system, their costs of goods sold was first estimated using the normal overhead. And meaning that overhead is going to be part of the cost of goods sold. And overhead was considered to be 478,720. However, we know that the actual production tells us different. The actual overhead is going to be $2,620 lower than the expected overhead or the unadjusted overhead. So meaning that it actually costs less. The goods produced actually cost less. So what do we do here? Here, if we put the actual cost of goods, the unadjusted cost of goods sold, we know that it's 707,000. And we know that the actual cost of goods sold should be lower because the actual overhead was lower than planned or than expected. So we know that the actual cost of goods sold should be 2,620 lower than 707,000. So the actual cost of goods sold should be $704,380. So that's the for all.